All right, welcome everyone to a new episode of Gimme Some Truth International edition. To my left is Keith Poniwaz. To my right is Stan Farmer. I'm Sil Michelin. And what we want to talk about today is what is happening in the UK. We want to give our listeners an update on recent developments with UK tax law and how that may affect, people in the US expat community in general. And
we weren't the only country that had a big election.
Right, we weren't. And I was talking to a prospective client earlier this week, and he had been on our website and commented that there was a lot of really good UK content on our site, UK-related content, but unfortunately almost everything about it was now outdated, and which I think
back to the drawing board.
Yeah, pretty much. So unfortunately, he's right. We have a lot of UK content that's going to be going to have to get updated because as of the end of October
30th.
October 30th, a lot of the UK tax laws and rules that we've been very familiar with over the years have completely changed, right? So for a long time, I think a lot of the advice that people moving to the UK were receiving really centered around this idea of being a res non-dom and benefiting from this form of taxation where effectively you would be taxed on a remittance basis.
Right.
Meaning that you would effectively be taxed only on your UK-sourced income, which for a lot of people may end up being just their employment income. And then any sort of offshore wealth that you may have had, that would be effectively untaxed, or at least not taxed until you sent those funds into the UK. And that was a regime that was called Remittance-Based taxation. And I think in its latest iteration, you benefited from that for a period of 7 years.
If you elected it.
If you elected it, right?
5 of 7. Yep.
So it worked pretty well. And, a lot of the discussions that we've had with people moving to the UK really was about how to make the most of that regime. But now that's all changing. Yep. So what are some of the key changes being implemented?
Well, and I think before we get into the sort of changes, one of the reasons that 5-year, 7-year period was helpful was to restructure your investments so they would be compliant with the rules that the HMRC has. So much like the US, we have a PFIC regime. In the UK, they have HMRC approved, His Majesty's Revenue Collection, approved fund list, and you don't want to have funds not on that list because if you become a domicile in the UK and have to pay capital gains tax rates on those investments, those are generally taxed at your income tax rate when you sell, which is mostly higher than your capital gains tax rate would be.
Right.
And so that's one of the things. Now, what they've replaced this kind of period where you can elect to be in a remittance basis, and then as well after the election, you could also pay a fee to continue to be on the remittance basis of I think it was £60,000 a year, and you could also do that basically for I think it was up to 15 years. And so a lot of wealthy investors, who had property elsewhere in the world, would do that. It was less, we'll say, effective for Americans because the UK capital gains tax rate and the US capital gains tax rates were very similar. And so that has also gone away. And what they replaced it with is basically if you move to the UK, it's FIG. And let me just double check what FIG stands for here. And basically what that means is for the first 4 years that you're there, you are allowed to basically work on the remittance basis. And so the FIG, Foreign Income and Gains regime, and basically for 4 years, and you can make a claim, much like you could before, to only be taxed on UK source gains in income. So you have still a period of time to adjust your portfolio should you move there, or if you're only there for a couple of years,
Right.
you are exempt. But if you're there longer than 4 years now, there's no way of escaping it.
Right.
You are now UK taxable
So
on everything.
After the 4 years is up, your entire global wealth and all income streams that you have globally will be subject to UK taxation. So it's now really, we came from this non-dumb remittance-based taxation regime that could last 7 years or more to a much shorter 4-year time frame where effectively you are not taxed on your offshore non-UK wealth, which is still pretty beneficial. I mean, realistically, not every country around the world gives this kind of, tax perk to new immigrants.
Yeah, I don't think, again, we used to talk about the remittance basis and the arising basis and what somebody should elect. And it always seemed to me that remittance was almost a trap that you could fall into, in the sense that tracking your unremitted gains is a Herculean task. It gets extremely complicated, and it's just a way that you could, unintentionally run afoul of the HMRC, in my opinion. So people that plan to move to England and stay there, or Scotland or Wales, I keep, when I say England, I mean the UK here, in general. And now I'm in trouble with people from Wales and Scotland.
Yeah,
too late.
definitely.
Too late. Northern
We're
Ireland.
going to get hate mail again.
The entire kingdom, united. But, if you're going to stay, this was going to lead to an accounting nightmare, right?
Yeah.
So this is, in that sense, this 4-year period to clean things up, to get yourself into suitable investments that work in the United Kingdom, can work out a lot better for people who move to the UK after, in this case, it's after April 6th. It's the new tax year,
right,
that's going to start next April.
Yeah, and I think that's a very important point, because obviously a lot of people are concerned about the changes. Is it going to hurt me financially? Should I maybe not move to the UK? But really, remittance-based taxation was a little bit of a trap, because it is true that if you collected income that was unremitted into the UK, it would still be potentially taxable in the event that you would eventually bring that money onshore. And so there were really two main issues. So first of all, for Americans, because you're taxed in the US anyway, the benefit of that remittance-based taxation were limited, because your tax rate is never going to be lower than the US tax rate anyway. So it was a, marginal benefit at best. And then when you consider the complexity associated with actually moving funds into the UK, if you had allow income to accumulate untaxed in an account outside the UK, it really wasn't really worth it. I mean, the nightmare scenario would be someone moving to the UK, and we've seen that with clients and people we talk to in the expat community. People move to the UK, they think, I'm just going there for a couple of years on a work assignment. For simplicity, they claim remittance-based taxation, and they keep investing in their U.S. brokerage account, and they think they don't have to worry about it, because anyway, they're moving soon. Next thing you know, 5 years later, they're still in the UK, they're married, they have 2 kids, a dog, and they want to buy a house, right? And they need to bring all their offshore wealth into the UK. And then at that point, they realize that they have a whole mess to deal with, because all that income that had gone untaxed suddenly has to be taxed in the UK and will be subject to these incredibly complex ordering rules. And that's the accounting
clean
nightmare.
Capital.
Yeah, exactly. And so especially if you didn't have the whole clean capital accounting and all of that, you effectively had a mixed fund, and it potentially would have been taxed very punitively. And so that's the accounting nightmare that you were referring to. And I agree that in many ways, this 4-year regime is, simpler, and it avoids some of the issues that people had in the past with, having to deal with clean capital and ordering rules and all that stuff. So in a way, it's a new era, a lot of changes, but I think it's not all bad. It's not all bad for expats.
Well, one thing that I think nobody in the UK will think is a positive change on their tax bill is simply the fact that the capital gains rates have increased.
Yeah, that is true. So part of the budget is an increase of the capital gains tax rate, I think from 20 to 24.
At the highest level.
10 and 20 were the
18.
two tiers for investment for investment capital gains,
Mm-hmm.
right? And they've gone from 10 and 20 to 18 and 24.
Right.
So
That's another change.
It's a pretty decent hike,
Mm-hmm.
and now it seems like the comparability of U.S. and U.K. capital gains the gap is a little wider now, right?
Yeah, potentially. I mean, you'd
Potentially.
really have to be in that really top bracket and pay the ACH surcharge in the US to get anywhere close to the UK tax rate now, I suppose.
Yeah, and related to that, it does behoove you now with this higher tax rate, to be very careful around that ACH charge in the U.S. because you don't get the tax credit in the UK.
Right.
So
Right.
effectively, if you bump up against that, your capital gains charge would be 27.8%.
Right.
So you have to definitely now in the UK be very mindful of that and negotiate that pretty carefully,
Right.
as well. There are also some changes, for people in private equity in terms of increasing the tax rate to 32.5% on carried interest for private equity. So there were some of these changes. One thing I think that I want to stress is the budget process there is so different from ours.
Right.
And, in the U.S., there's a budget. It, gets proposed.
There used to be.
There's bickering back and forth, and you lay out a tax plan. I mean, the last sort of major tax overhaul like this was in 2017, and it went on and on for the whole year, and they finally got it done in December, right? But you knew more or less what was in the bill. You could prepare for changes, insofar as they didn't go into effect immediately.
Right.
The interesting thing about the UK budget is certain of these changes basically went into effect when she announced them. So,
Right.
From our side, there wasn't a lot of planning we could do.
Right. That's true.
Because we didn't know what was in the budget until the budget was revealed. And, some of these things, it was like, well, as of October 29th, you can't do that anymore.
Right. Not helpful when you're reading about it in November.
Yeah,
Right.
Exactly.
Yeah.
And so, that has led to, and we tried to help some clients in these situations based on speculation of what
Right.
we might see. But we didn't know, for instance, that there's the temporary remittance facility, which for basically the next 3 years, people with offshore gains can bring them into the UK at a lower tax rate at 12%, and then in the third year it's up to 15%. We didn't know how that was going to work out mechanically,
Yeah.
right? And so, should I bring money over? What should I do? Yeah, I guess.
You still have to wonder if exactly how it's going to work mechanically.
Yeah.
Right?
Yeah,
exactly.
and how it gets taxed. But so it's a very different system, right? We had a podcast here talking about possible sunsetting of changes to inheritance tax in the United States in 2025, whereas
Yes.
they made some massive overhauls of their estate tax regime,
Right.
inheritance tax regime, and basically said, okay,
Well, I mean,
good luck.
And let's talk about that, because I think that those are even more fundamental changes. I think that they're dramatic, right?
Right.
I mean, at least the lawyer in me thinks so, because the concept of domicile is a common law concept that the United States adopted from Great Britain, and obviously there were domicile rules that included statutory period for which, if you stayed in if you stayed in Great Britain or the UK long enough, you would become deemed domicile. Throw all of that out the window now, okay? But keep in mind that domicile was somewhat subjective. So you could be domiciled in the UK and not know it because you haven't yet been there for the statutory period. Now it's a straight line test. If you are in the UK as a tax resident for 10 of 20 years, it is automatically kicked in. You are a long-term resident. They've gotten rid of the term domicile, okay? And if you are a settler of a trust where you've kept things that are offshore in a trust thinking it will protect you from IHT, once the settlor of the trust is a long-term resident, that trust is a long-term resident of the UK. So now there's this pretty straight line test for when IHT applies to your worldwide wealth. And I think that residency-based test is a fairly dramatic change.
It's a huge change, and it's also part of the October budget changes, and so it covers really income tax, as we discussed, but these changes on the inheritance tax front are potentially even more significant, especially when you consider that so much planning advice really that was given to ultra high net worth and high net worth families in the UK is effectively become in some cases worthless.
Potentially much more impactful for Americans too, because let's remember, we have an income tax that applies to worldwide income. So the fact that more income might apply to the UK income tax, it's a marginal change because you've got foreign tax credits that are going to, minimize that dual taxation, if you will. But on the IHT or UK estate tax and the US estate tax, you've got this ginormous gap in exemption amount, right? And it's going to stay ginormous because even if the U.S., even if we do get a sunset, which is seeming less likely now, right? A family would still have, 15, 12, 13, 14, 15. It increases every year.
Right.
The amount of lifetime exemption you've got from estate and gift tax. In the UK, it's basically £1 million, including your house.
Right.
Right? And that's not going to change.
For a married couple, yep.
Yes, for a married couple. That's not going to change now, at least through April of 2030. They're not going to give any augmented increase for inflation to reflect in that exemption.
So effectively, that ginormous gap that you're referring to for a married couple would be the difference between $1 million and 26 or $27 million.
Yeah, right? I mean, close enough, right? I mean, it's the gap itself is
and it's going to keep
daunting.
growing between now and 2030.
Yeah,
because
and
that is linked to inflation in the United States,
and now the UK. The U.S. is always included, if you die with a huge IRA, that's part of your estate, right, automatically. That was not the case in the UK with regard to UK pensions. But now, die after 2026, it's now part of your estate. So that's another big change.
Yeah.
And as Syl alluded to, now there's no way to lawyer yourself out of IHT on your offshore wealth if you become a long-term resident. Right. And if you have one of these trusts and you're a long-term resident, now the trust is a long-term resident. If you leave, you can break long-term residency, but it takes 3 to 10 years depending on how long you were a resident of the UK. And once you break it, guess what? That trust you created is subject to exit tax of 25%. So a lot to unpack there.
Yeah. One thing, just to, kind of alert Americans, though, the protections of the U.S.-UK estate treaty are still in place. They made that explicit. And so according to that, if you are a U.S. citizen and not a resident of the U.K. for 7 years, less than 7 years, and importantly not a U.K. citizen, you can basically
relevant.
elect to use the U.S. As the place of domicile, right, as part of the tiebreaker test. And so I think it's very important now. It used to be that there were minimal tax considerations with getting UK citizenship. That has now changed. And so something that, usually when we talk about citizenship, it's a relatively financially neutral decision.
Yeah.
That no longer applies with the tiebreaker test for domicile. It has now become an important kind of consideration, and should impact that if you're thinking about your estate longer term. Becoming a UK citizen basically means if you're living there, they're going to consider you domiciled by the treaty tiebreaker tests, and you're looped into that tax code all of a sudden and giving away that.
Of course, you're not a long-term resident in the UK until you've been there for 10 years. So, there's that too.
Yeah.
Right.
So. Absolutely. So, like you said, Stan, a lot to unpack. What we wanted to do today is just share a high-level summary with our viewers. Again, changes to the way income tax is going to work, changes to the way UK IHD is going to work. So over the next few months, I think we'll get more familiar with how these rules are going to be applied and how that's going to kind of shape the advice that we give. But we felt it was important to just give a little bit of an update on what's been happening. So hopefully you found it useful, and we'll wrap it up for today, and we will see you next time for the next episode of Give Me Some Truth International. If you like the content, be sure to like and subscribe.
Smash that like button, please.
Walkner Condon Financial Advisors is a registered investment advisor with the SEC. Registration with the SEC does not imply a certain level of skill or training. The opinions expressed by the participants of this podcast are their own and do not reflect the opinions of Walkner Condon Financial Advisors. All statements and opinions expressed are based upon information considered reliable, although it should not be relied upon as such. Any statements or opinions are subject to change without notice. Information presented is for educational purposes only and does not intend to make an offer or solicitation for the sale or purchase of any specific securities, investments, or investment strategies. Investments involve risk and, unless otherwise stated, are not guaranteed. Information expressed does not take into account your specific situation or objectives and is not intended as recommendations appropriate for any individual. Listeners are encouraged to seek advice from a qualified tax, legal, or investment advisor to determine whether any information presented may be suitable for their specific situation. Past performance is not indicative of future performance. Thanks for listening, and for further information, please visit WalknerCondon.com.